Hello everyone, this is ACCA Amit Kumar and we'll discuss the December 2019 question based on consolidation. So in a diploma in IFRS examination, the first question is always based on consolidation. So this becomes very important for us to understand how to perform a consolidation question. So let's have a look at the recent examination which happened in December. After that, there was no examination held in June 2020 and will be now appearing for DipIFR examination in December 2020 now, after 1 year of this examination. So let's have a look at this. So whenever we begin a question, first read the requirement and then only read the question, so that we know whether it is a income statement question, balance sheet question, or it is simply asking us to calculate Goodwill, NCI, or may want us to only calculate group retained earnings. So it helps us to know what is the requirement. Using the draft statement of financial position of alpha and its subsidiary beta at 30th September 20x7 and the further information provided in notes 1 to 4. So there are 4 notes in this question. Prepare the consolidated statement of financial position of alpha at 30th September 20x7. Now earlier this used to be a 40 mark question, but now it is a 25 mark question. So there is a myth that the question size is going to be shorter, but as far as consolidation procedures are concerned, there is no change. The only difference is that the notes which were lengthy, like apart from just 4 notes here, there used to be 6 or 7 notes in this question which was covering 40 marks. But now this has made our life easier, that they'll be testing only consolidation as part of 25 mark question, and the knowledge relating to other accounting standards will be tested as part of other questions. So it doesn't form part of a consolidation question. So it makes our life easier that if we commit any mistake in an accounting standard question, that doesn't impact our consolidation. Though accounting standards will still continue to be tested as part of consolidation. Like in this case, there is a pension liability note, there is a convertible loan note. So other standards will continue to be tested, but the length of the question has become shorter as compared to the previous 40 mark question. So we are given the draft financial statements of alpha and beta. Beta is a subsidiary here, and we need to prepare financial statements of 30th September 20x7. So we are given PP. So there is a note 1 relating to it. There must be some fair value adjustments relating to it, development project. Then there is investment in beta. We have invested 4,50,000. In investing 4,50,000, how many shares we must have acquired? There is 1,60,000 shares of beta. Out of 1,60,000, acquired 120 million shares in beta, and that too on 1st April 2007. We are preparing financial statements of 30th September 20x7. So that means just 6 months before this, we acquired this entity. So this is a mid-year acquisition. So date of acquisition, date of balance sheet becomes really important. So note 1 is relating to fair value adjustments about the group structure. Note 2 is relating to intra-group trading. Alpha has applied to beta, now parent selling to beta. So we'll be making the adjustment in working note number 5. Then there is a long-term borrowing and pension liability. So comparatively an easier question. So let's have a look at it. So for doing a balance sheet question, as I said, you can leave some space, consolidated statement of financial position as on 30th September 20x7. We need to prepare consolidated financial statement of 20x7. There are assets, non-current assets, non-current assets, property, plant and equipment. So the line items which are existing as part of the balance sheet, definitely they will be appearing as part of the consolidated balance sheet. Development project in alpha's books is 0, in beta's books it is 20,000 at the end of the period. So we'll need to include any fair value adjustments if there is any. So we'll include development project. Investment in beta will be replaced with goodwill if there is positive goodwill, else it will be forming part of P&L. So we'll have a look at it. This investment in beta will not be including. We'll leave some space. Current assets. There is inventories. In inventories, there is unrealized profit, there is intra-group trading, trade receivables, cash and cash equivalents, inventories are 165,000 plus 92,000 plus 92,000, trade receivables 99,000 plus 76,000, cash and cash equivalent is 18,000 plus 16,000. If you wish to include relating to property, plant and equipment also, you can include 966,500 plus 546,000. Though we'll be using the fair value adjustments, at least the ones we can add up, we should add up. And there are total assets. After total assets, we'll be having equity and liabilities. Equity and liabilities. In equity and liabilities, we'll only be including share capital of parent only. The equity, share capital of parent only, which is equivalent to 3,60,000. Then there is retained earnings, which will be replacing with group retained earnings. We'll do a working relating to it. You can write working note number 5. We'll be taking the figure from working note number 5. Then there are other components of equity. So if there is other components of equity, you can give a note number 6 to it, and we'll create a separate note for it. Why we'll create a separate note for it? Because there is a convertible loan, there is a pension liability, which will both result in other comprehensive income remeasurement or equity portion of a convertible loan. So you can be assured that this amount is going to be increased, or there will be some changes relating to it. So we'll make adjustments in it. So for the moment, simply write working note number 6. We'll make adjustments. We'll bring it from the working notes. Apart from this, there will be one more item which will be including, that will be non-controlling interest. Because we just noticed that Alpha did not acquire 100%. They acquired 120 million out of 160, which gives us an indication that there is a non-controlling interest. Non-controlling interest working is working note number 4. So we'll get the total equity, and after that we have non-current liabilities. Non-current liabilities are further divided into long-term borrowings, we can give a note number 7. We'll have to calculate it yet. Pension liability, note number 8. Deferred tax, we'll be picking the figure as given in the balance sheet, that is 69,000 plus 54,000 plus 54,000, plus if there is any fair value adjustments, we'll be picking it from working note number 2, plus if there is any deferred tax implication of an intra-group trading, we'll be including it there. We'll have a look at it later. Total non-current liabilities. Total non-current liabilities. Then we have current liabilities. So the line items which are there as part of the balance sheet, they will exist as part of your consolidated balance sheet as well. There may be some more line items which you may have to include. Trade and other payables. Trade and other payables turns out to be 70,000 plus 59,000. 70,000 plus 59,000. Short-term borrowings. I call them free marks. 40,000 plus 32,000. Total current liabilities. Now let's read it. We'll get the total equity and liabilities. Compared with the total assets. Leaving some space, we can begin from working note number 1. Working note number 1 is always group structure. Working note number 1 is always the group structure. Define the group structure. Alpha is the parent, beta is subsidiary, acquired 120 million shares out of 160 on 1st April 2007. 120,000 out of 160,000 into 100 gives us 75%. NCI is 25%. Date of acquisition is 1st April 20x7. Date of balance sheet is 30th September 20x7. How many months? 6 months period. Mid-year acquisition. Working note number 2 is net assets of subsidiary. Net assets subsidiary on date of acquisition, that is 1st April 20x7. Date of balance sheet 30th September 20x7 is the date of balance sheet. I'm purposely writing the date so that there is no confusion. So this, in the new exam pattern, we should be writing it in this manner. Share capital, retained earnings, share capital position of subsidiary is 1,60,000. Retained earnings is 3,60,000. 1,60,000, 3,60,000. What was the retained earnings position on the date of acquisition? Alpha made a payment of 450 million in exchange for these shares. The individual interim financial statements beta showed a balance of 340 million on its retained earnings on 1st April. 340,000 is the retained earnings position on the date of acquisition. Then there were fair value adjustments. Among the fair value adjustments, plant and equipment having a carrying value of 440 million had an estimated fair value of 480 million. The estimated useful life on 1st April 2007 20x7 is 4 years. So plant and equipment, there's an increase of 40,000. This 40,000 is having a life of 4 years, that is 48 months. 6 months have already passed, that means 42 months life is remaining. 35,000 is the date of balance sheet amount. $40,000 divided by 4 years, 48 into 42, since 6 months depreciation charged. I'm writing this for your explanation, otherwise we could have done it directly. An in-process development project of Beta had a carrying amount of 8 million and a fair value of 18 million. During the 6-month period from 1st April 7 to 30th September 7, Beta incurred further development cost of 12 million relating to this project. These costs were correctly capitalized in accordance with requirements of IAS 38 intangible assets. So according to Beta's process, they had a carrying amount of 8 million. They further incurred 12 million. They have already recorded 20 million. If you notice here, development project, they have recorded 20 million. 20 million is already included as part of Beta's balance sheet, which I must also have included 20,000. That means what is pending to be included? What is pending to be included in this 20,000? In this 20,000, they had a fair value of 18 million. This 10 million difference, 18 minus 8, is yet to be done. These costs were correctly capitalized in accordance with IAS 38. No amortization done. No amortization was required prior to 30 September 2020X7. So we'll not be charging any amortization on this development cost. So the fair value of 10 million is not included. So we'll need to include this fair value of 10 million. And this is not subject to amortization, so this balance equals 30,000. So since we got to know that there is a development project of 10,000 which we included it directly as part of the balance sheet, we also know that plant and equipment's balance sheet value is now 35,000. So we can include 35,000 as part of plant and equipment. Property, plant and equipment is 966,500 plus 546,000 plus 35,000. So the total amount to be included as part of the balance sheet for property, plant and equipment will be 966,500 plus 546,000 plus 35,000 is the total amount of plant and equipment to be included. So intangible asset recognized here will be 10,000. Date of balance sheet will be 10,000 since there is no amortization. 8 million, 12 million spent, total 20 million already capitalized, 10 million yet to be capitalized. So 20 plus 10, 30,000 to be capitalized. 10 million fair value 10,000, no amortization 10,000. The fair value adjustments have not been reflected in the individual financial statements of Beta. In the consolidated financial statements, the fair value adjustments will be regarded as temporary differences for the purpose of tax, and the rate of deferred tax is 20%. Deferred tax at the rate of 20% will be equal to minus 20% of 50,000. Minus 20% of 45,000. 9,000 is the deferred tax liability balance on the date of balance sheet. The net assets position on this date equals 5,40,000 is the net assets position on the date of balance sheet. It is 556,000. The difference between the two is post acquisition profit, which is to be divided between alpha and NCI. Alpha has a share of 75% of 75% of 16,000 belongs to alpha, which will be presenting as part of working note number 5. 25% of it belongs to NCI, which will be presenting as part of working note number 4. Next is working note number 3, calculation of goodwill, in which we'll need purchase consideration. Purchase consideration is given to us as 4,50,000 was the payment made. 4,50,000 was the payment made. We'll need value of NCI. NCI is out of 160,000 shares, 120,000 shares were acquired, 40,000 shares, and NCI is valued at fair value on 1st April 2007, 3.80. So 40,000 into 3.80. 40,000 into 3.80 is the value of NCI. Fair value of net assets or subsidy on date of acquisition. On date of acquisition. Is equal to net assets on date of acquisition was 5,40,000. So goodwill amount was equal to, and this is known as full goodwill belonging to parent as well as NCI. We'll see if there is any impairment of goodwill. Is there any information relating to impairment of goodwill? There is no information. So this goodwill amount will be presented as part of the balance sheet here. Goodwill, working note number 3, is equal to $62,000. Working note number 4 is valuation of NCI. Valuation of NCI, non-controlling interest, on date of balance sheet. For that we need value of NCI on date of acquisition, which is equivalent to 152,000 plus share of profit of NCI, which we got from working note number 2, is equal to 4,000 25% of 16,000 and 75% of 16,000. Working note number 5 is group retained earnings. Group retained earnings, in which we have parents' earnings, which is equivalent to, parents' earnings is 5,70,000 plus share of post acquisition profits, working note number 2, we'll get it from here, 12,000. So we have dealt with note 1, we have dealt with Note 1 completely, we need to deal with note 2. Since 1st April 2007, Alpha has supplied a product to Beta. Alpha applies a markup of 25% to its cost of supplying this product. Sales of product by Alpha to Beta in the period from 1st April 7 to 30 September 7 total 30 million. One third of the products which Alpha has supplied to Beta since 1st April were still unsold by Beta. That means 2/3 are sold, 1/3 is unrealized. Out of 30 million, 10 million is unrealized. Any adjustment which is necessary in consolidated financial statements as a result of these sales will be regarded as temporary difference for the purpose of computing deferred tax. The rate of deferred tax to apply is 20%. No amounts were owing to Alpha. That means there is no cash in transit or goods in transit, no cancellation between Alpha and Beta as far as trade receivables or payables is concerned. Only there is intra-group trading, that too in the balance sheet, so we'll only be eliminating unrealized profit. Here the sale is being made by the parent. If the sale is being made by the parent, we'll make the adjustment in working note number 5. Less unrealized profit on sale of goods equivalent to 30,000 into 1/3 that equals to 10,000 divided by 125 into 25 equals to 10,000 divided by 125 is equal to 2,000 is unrealized profit. Tax at the rate of 20%. $2,000 into 80%. 1,600 is the unrealized profit to be eliminated. Minus 1,600 is the unrealized profit to be eliminated on sale of goods. Note number 3, long-term borrowings. Prior to 1st October 20x6, Alpha had no long-term borrowings. On 1st October 20x6, Alpha borrowed 300 million to finance its future expansion plans. The terms of borrowing is 5 years and annual rate of interest payable on the borrowing is 6%. Alpha charged interest paid on 30 September 20x7 as a finance cost in its financial statements for the year ended 30 September 20x7. The borrowings are repayable in cash at the end of 5-year term or convertible into equity shares on that date at the option of the lender. Now, since there is an option available, so the rate of borrowing is 6%, but the same borrowing in market would have given an annual return of 8% if there was no conversion option. Discount factors are given for 6% and 8%. So we need to know how much is the equity portion. This is a compound financial instrument. How much is equity portion and how much is the debt component. So the total borrowing on 1st October 20x6 is 300 million. So working note number 6, we thought to give to other components of equity. Other components of equity, so we'll leave space for it. In other components of equity, there will be 2 components, one from unrealized gain or loss from pension and one will be equity portion from this entity. So working note number 7 is actually for long-term borrowings. Long-term borrowings means that cash proceeds received on 1st October 20x6 on 1st October 20x6 is equal to 300,000. The repayments are as follows. 6% of 300,000 that is equal to and this will be for a period of 5 years, and the present value of all these payments over a period of 5 years is, if we take the annuity table, at market rates of interest for payments which are going to be made at the end of each year is 6% of 300,000, that is 18,000. But if the same would have been borrowed at market rates of interest, what would have been the present value of all these payments? So 18,000 being paid at the end of each year for a period of 5 years. What is the present value of these constant cash flows? So since there is a constant cash flows, we can use an annuity table to know the present value. So 18,000 multiplied with 3.99 is equal to 18,000 into 3.99. This is the constant cash flow present value of all these payments over a period of 5 years. At the end of 5 years, we'll be repaying. We'll see at par or at premium or at discount what is the repayment. The borrowings are repayable in cash at the end of the 5-year term or convertible into equity shares on that date. So principal repaid at an amount of 300,000 and the present value discounting at the rate of 8% is 0.681. 0.681 into 300,000. The total of these two amounts is the liability in today's terms. This is the liability to be recognized as part of the balance sheet. So that means the equity portion is the difference. 300,000 minus 276,120 is the equity portion. This will be also presented as part of other components of equity. Equity portion of compound financial instrument is equal to 23880. Now this liability at the beginning of the year, liability at the beginning of 1st October 20x6 is equal to 276,120 plus interest charge on it at the rate of 8% is equal to 8% into 276,120 less payments in arrears at the end of the year, that is 18,000 is equal to 276,120 plus this minus interest. The liability balance at the end of the year is 280,210. So this is the interest charge for the year as of 30th September 20x7. The interest charge is 22090, and what has been charged till now? Alpha charged the interest paid on 30th September 2007 as finance cost in its financial statements. That means we need to reverse this 18,000 and need to charge actually 22,090. So reversal of interest charge, $18,000. Interest charge for the year is equal to 22,090 is the interest charge for the year. The long-term borrowings, which is to be presented as part of the balance sheet, long-term borrowings 300,000 plus 85,000, 300,000 plus 85,000, plus compound financial instrument, so this 300,000 will be replaced reversal minus 300,000, liability to be recognized by the end of the year is equal to 276,120 is the opening liability, and closing liability is 280,210. Now let's have a look at the pension liability plan. Now this is covered under IAS 19 employee benefits, wherein we get the opening balance from the balance sheet, closing balance. We are able to charge the current service cost, interest charge, are able to deal with the contributions. But in spite of doing all this, we are still not able to recognize the difference between the opening balance and closing balance, which is known as unrecognized actual gain and loss. Alpha has established a defined benefit pension plan for its eligible employees. The statement of financial position of Alpha at 30th September 20x7 currently includes the estimated net liability of 30th September 20x6. So it means to say that the closing balance given on 30th September 20x7 is equal to the opening pension liability, which was at the beginning of the year. So we can say that the balance of pension liability, which is included as part of the balance sheet, 187,500. Now this is the trick played in the question. So we need to read every line very carefully. Now this line is creating the confusion because we are believing that this is the closing balance as of 30th September 20x7. But by inserting this line, let's read again. The statement of financial position of Alpha at 30th September 20x7 currently includes the estimated net liability at 30th September 20x6. So that means the opening balance is 187,500 is the opening balance. Working note number 8, pension liability, opening balance is equal to 187,500. On it will be charging interest at the rate of 8%. $15,000. This interest charge we need to include as part of the group retained earnings as well. Interest on pension plan, it is minus 15,000. And there is current service cost of 60 million. Which also increases the liability. Current service cost to be charged into P&L 60,000. Alpha paid contributions of 70 million into the plan and charged this amount as an operating expense. The contributions, the credit is cash and debit is asset. This reduces the liability but is not shown as part of P&L. So contributions will definitely reduce the liability. Contributions will definitely reduce the liability but will not be forming part of P&L. Reversal of charge to P&L. Add back 70,000. The estimated net liability balance on 30th September 20x7 should be 205 million. So the closing balance as given by the actuary is 205,000, and if there is any difference, that forms part of unrecognized actual gains and losses, which is actually 192,500. 205,000 minus 192,500. 12,500 is the unrecognized actual gains and loss. Unrecognized actuarial loss is equal to 12,500. This unrecognized actuarial loss will be forming part of other component of equity. Because this increases the liability. Since this increases the liability, this is a loss. The liability balance was 187,500. It increases with interest charge, increases with the current service cost, reduces with the contributions, and the balance is 205,000. There is an increase in liability of 12,500 because of this unrecognized actuarial loss, which also reduces the unrecognized actuarial loss. Working note number 8 is equal to minus 12,500. The opening balance of other account of equity is 102,000. 102,000 equivalent to 102,000 plus 23,000 minus 12,500. 113,380 is the amount to be included as part of other components of equity. So after we have dealt with other components of equity, do not forget to include it as part of working note number 6. As part of the balance sheet, other components of equity is equivalent to 113,380. Valuation of NCI and rate of balance sheet is equivalent to 156,000. Working note number 4 is equal to 156,000. Let's give a total to group retained earnings. It is equal to 571310. Working note number 5, 571310. Working note number 8, his pension liability is 205,000. Deferred tax 69,000 plus 54,000. Include the deferred tax liability 9,000. And there was an intra-group transaction in which we also dealt with deferred tax liability. Intra-group transaction we dealt with was 400 was deferred tax liability. So we reverse the profit. So there's a DTA of 400 and therefore tax liability of 9,000. So this will result in therefore tax liability balance will result in plus 9,000 minus 400. Both will be dealt with as part of working note number 2. So equals to 69,000 plus 54,000 plus 9,000 minus 400. 13160 is deferred tax liability balance. Trade and other payables 70,000 plus 59,000. Short-term borrowings 40,000 plus 32,000. Non-controlling interest we have taken long-term borrowings is equal to 280,210 is a long-term borrowing liability balance. Inventory 165,000 plus 92,000 minus 2,000 unrealized profit is equal to 99,000 plus 76,000 is equal to 18,000 plus 16,000. Inventory, there is an unrealized profit of 2,000. 1,600 is deducted from group retained earnings. 400 is deducted from deferred tax asset. Two 103,500 is the total of assets. What is missing? Which I have not included. Two 103,500 minus 85,000. So what is the mistake I am committing? See, I do not wish to be perfect. Even I can commit a mistake. So when I look at the long-term borrowings, pension liability, deferred tax, I've taken into everything. Share capital of parent only, retained earnings, other accounts of equity. There's a difference of 85,000. I have missed taking the difference of 85,000 of long-term borrowings. If you look at the long-term borrowings balance, we had taken into account long-term borrowings of parent plus 85,000. We calculated here the liability to be recognized, but the total balance is supposed to be 3,85,000 minus 3 lakh plus 280,210. 365 250 is the amount to be recognized as part of the balance sheet. So total long-term borrowings is 3 lakh plus 85,000. Had written it here but missed taking up the total, since I directly picked up the total only of the liability, missed taking up the. So when I took up only 280210 as part of the total long-term borrowings, only 280210, this means that I've taken only the long-term borrowings of parent only, missed taking up or adding up the long-term borrowing of subsidy. So total balance is 365210 actually. So this helps us in preparing consolidated balance sheet the total assets figure is equivalent to 2103500 and total equity and liabilities 2103500. This is how we present consolidated statement of financial position as of 30th September 20x7. So 5 workings are essential. Working note number 1, 2, 3, 4, 5. If you do, you get marks for every line item done correctly. Working note number 6 was a special working we introduced. Deal with long-term borrowings, pension liability. This is the total balance, closing balance, which should be forming part of the balance sheet. And since I was writing this long-term borrowings, I committed a mistake, which I've rectified in the end, because when I totaled up, I got to know that there is a difference of 85,000, which by looking at the balance sheet, I could make out the difference. So this is how we deal with consolidated balance sheet question. So it's time for a celebration whenever the balance sheet matches. So this is all for it. If you have any doubts, please reach out to me so that I can clarify your doubts. And request to read the question properly, read every line item, since every line has a meaning, so nothing should be ignored. We should not overlook anything, so we'll be able to successfully complete a balance sheet question. Thank you.